With rising rates, distressed deals, and shifting market dynamics, multifamily expert Ashley Wilson will share today how savvy investors can navigate today's challenges. I'm Kathy Fetke, and welcome to the Real Wealth Show.
You're listening to The RealWealth Show with Kathy Fetke, the real estate investor's resource.
Ashley Wilson is one of the most respected voices in multifamily real estate today. With over $165 million in transactions, multiple successful businesses, a best-selling book, and a passion for mentorship, she's seen the industry evolve through many cycles. Today, she's here to share her story and, more importantly, help us understand what's happening in the multifamily market today. Ashley, it's so fun to have you on the show. Welcome.
Thank you so much for having me. I am super excited to be here.
Well, you are one of the only women in the room with me, and you actually wrote a book with that title. We're often at the same conferences, speaking, educating. Before we get to what you're doing currently and how you see the market today, let's just go back to how you started in real estate.
I started in real estate while I was working in clinical research and development for a pharma company. Both my husband and I were not huge proponents of the stock market for various reasons. And he was exploring alternative investments and landed on real estate. So we started with house hacking. We did short-term rentals, long-term rentals, flipping, high-end flipping. And then we ultimately landed in commercial real estate a few years ago in 2017, 2018, and have been doing commercial real estate since then.
And you have to tell us a little bit about your lives before that, because that'll be fun to talk about.
So my husband was a professional ice hockey player. So one of the things that comes along with being a professional athlete is it's a short-lived career, and knowing what you want to do in your next season of life is really important. There are a lot of athletes who mismanage their money and end up being an entry-level position in their 30s. That's not something my husband wanted to do, but he also was not in a position where he was a star in the NHL, so we could sit back and just enjoy his retirement for the rest of our lives. We had to figure out a way to participate in tax advantages and then also invest for hedges against inflation and be really smart with our money. So that's one thing that was a pretty unique aspect of our story. So while we were investing in real estate, we moved to, I think it was over 41 times, but we lived in Europe, Russia, and all over the US. So the thing I think that came out of that experience that really helped us build the companies we have today is the ability to manage and operate from afar, because you really have to understand the importance of communication and team building to execute on larger projects.
Oh, that's such a good point. Yeah. So you were investing while traveling?
Yes. So the short-term, long-term rentals, the flipping, high-end flipping, that was all done from afar. And even today, our entire multifamily portfolio is out of state. So I have not managed living in the same area for almost my entire real estate career. And ironically, when I worked in clinical R&D, so essentially what we did is we ran clinical trials before regulatory approval. I always worked in a remote capacity too. So since graduating from college, I don't think I ever had a position where my entire team was co-located. So it's a skill set that I think that I do really well, just because of the fact that I have my entire experience is based off of that.
Yeah, totally. I mean, that's so many of our Real Wealth listeners. They live in San Francisco or LA or New York, high-priced markets, or overseas. We get lots of people calling from Europe or Canada or other countries that want to invest in the US and can't be there. So you have to rely on a different set of skills. So what would you say are the most important, let's just say the top 3 most important skills you need to develop if you're going to be investing in a town that you are not in property that you cannot see every day?
The first skill set that's most important is the ability to identify great talent. So the ability to identify folks that fit the criteria you're looking for. And I'm not talking from a resume perspective, I'm talking about from an internal skill set perspective. When I look to hire folks, the last thing I look at is their resume. I actually look at their skill sets in terms of who they are as a person. So,
Hmm.
for example, I find that underwriters tend to be more introverted. They're highly analytical, and they are folks that if there were 3 Christmas parties at the end of the year, they would get anxiety just getting an invitation to one, as opposed to someone who's really good at raising capital tends to be someone who doesn't always have to be, because now with technology you can automate a lot of communication, but they tend to be really good at personal connections, communication. They might not be so detail oriented, they're better at understanding larger pieces to a puzzle. So it's understanding those skill sets to understand who is the right fit. So that's the first thing I would say is really important. And it's ironically the same way that I always advocate for reviewing a deal is you look at the team first. So I think the team is the most important aspect when you're looking to invest from afar. The second would be the market itself,
Mhm.
understanding different market criteria and why they are important. The interesting thing with identifying a solid market is you can talk to 100 people and we all have access to the same amount of data, but we rank that data differently. So, for example, if I am opposed to investing in a market that is high natural disaster risk, that doesn't mean that that market is a bad market in which to own and operate. It means that my business skill set and operational plan lends itself better to markets that are not in natural disaster zones. I actually met at a Bigger Pockets conference a gentleman who only invests in natural disaster zones because he banks on there being a natural disaster and leverages the insurance to rebuild the property at some point. So he comes in with a long-term hold strategy in a disaster prone area, revamps the property after a natural disaster, and then exits right after that, which I thought was a very unique strategy. And for that reason, he's able to not have as much competition on entry. I mean, there's a lot of benefits to that, but he just has a different business model than I do.
I was just on Mikey Taylor's podcast. He was like a big skateboarder, and now he builds multifamily in California. And he said, "Do you invest in California?" I said, "Not anymore. We used to do ground up construction in California, and it's just so hard. We've done some entitlement programs or we've done some entitlement syndications, but then we just entitle and get out. We just want to get out and not deal with all the regulations in California." So I said, "How are you doing it?" And he said, "Well, that's our one focus. So we're really good at it and it works for us." So yeah, everyone has a different plan. The key is you just have to know it well, dive in deep and be the best at it.
My third is actually a combination of understanding not only the current market demographics, the future of the market demographics, coupled with the appetite of your investor pool of funds, of where you're getting your capital from. I think markets that are very opportunistic, you have probably a set of investors that are a little bit more inclined to take a risk as opposed to investors who maybe might be looking for more mailbox type investments, maybe more core plus assets in major MSAs. So, for that reason, I think it's really important to understand your investor database to be able to decide whether or not that's a good market fit with all of the other factors at play.
Okay, so given all of that, let's talk about the last few years because you sort of went big on multifamily at a time when it was a bit of a frenzy. Seems like when you began, there was just there was so much competition. And then, you've gone through lots of changes. So let's talk about the last 5 or 6 years that you've been in the multifamily space and how that's been and how it is now.
In 2017 is when we started exploring different asset classes we could go into, and we landed on multifamily for a plethora of reasons. One is it's a natural hedge against inflation. Two is the tax benefits. Three is just the ability to pay down your debt while increasing the evaluation of the property. Four is the ability to control the property, and so on. There's a whole list of reasons of why we really like multifamily as a long-term play. I think a lot of folks gravitated towards multifamily at the end of, I would say, like 2020 through 2022. And I think the reason for that was due to a combination of interest rate environment coupled with the fact that it was an easy turn and burn, and you were able to own and operate these properties without actually operating them and be rewarded for not operating them. And what I mean by that is people were able to exit these properties without operating them, get handsomely rewarded. So it was like a Pavlov dog situation. And then they wanted to rinse and repeat.
So let's talk about what you mean there, because a lot of people might not understand who aren't involved. The interest rates were so low. And then you could also get financing for the renovation. So you could acquire a multifamily property, borrow the money to fix it up, and sell it, basically flipping apartments. And people were walking away with millions, not to mention the syndicators could charge pretty hefty acquisition fees, just even if they did nothing. So maybe that's what you meant by not operating, is they just buy it, get all that acquisition fee, could be in the millions. And then the market was taking prices up because of those low interest rates, so they could turn around and sell it for millions more. I mean, is that what you mean by not operating them?
Yes. And I also mean the fact that people will pay more if a property is quote unquote a value add property, because there's runway in which you can push the evaluation. In residential real estate is typically evaluated off of a comparable sales approach. So if it's 3 bedrooms, 2 baths, and the next door house is 3 bedrooms, 2 baths, if that house sells for a certain price, then the neighboring house will sell within the realm of that price. Whereas commercial real estate is evaluated 3 different ways. One is the comparable sales approach, which is rarely used. Number 2 is the replacement value. That's how insurance companies evaluate commercial real estate. But the third is what's called the net operating income approach, which allows you to control the evaluation of the property based on how you actually operate. So it's a calculation based off of the net operating income. So your operating income minus your operating expenses times a multiple, a trading value in that space. So what ends up happening is you can control the evaluation, whereas in residential real estate, you can't. So a lot of people were attracted to commercial real estate because of the idea of, okay, it's flipping on steroids. We can take this property, we can get in at a low interest rate environment. To your point, we can offset the CapEx money that is needed to do these renovations through a loan and turn around and sell it very quickly. And what happened is it was almost like putting lipstick on a pig. So they did all these renovations that were exterior in nature, attractive, but they never learned to truly operate. So what ended up happening is we had all these properties transacting very quickly. And then a domino effect to that is there's a tax advantage strategy in the US for anyone who's listening outside of the US of a 1031 exchange, which essentially allows you to take your gains from one asset and then use those gains to buy another asset. There are obviously nuances to this, and check with your financial advisor for this, as I'm not a CPA, but you can offset your tax exposure by transferring your gains from one property to another like-kind property. So instead of getting a tax bill for $5 million, overpaying on a property by $3 million doesn't seem like such a big deal, because the alternative was you were going to pay $5 million in taxes. So then it inflated the evaluations of these properties very quickly because of the fact that people wanted to place their capital and they didn't want to place it with Uncle Sam and never see it again. So I was living during this time period because I saw the opportunity in multifamily a few years prior to everyone else coming in the late 2000s and 2019, 2020. And then we had a low interest rate environment. But one of the things I recognized when I came into multifamily, and it was the first time I ever realized this, was in 2017 or 2018 as well, which was I always knew that there were different market cycles. And I thought that there were different market cycles based off of asset class, but I didn't realize that there were different market cycles based off of the asset class within a given market. Specifically, what I mean is that we have these different market cycles of hypersupply, recession, recovery, and the only two markets in the entire country in multifamily in specific areas that were coming out of a recession were Houston and Little Rock, Arkansas. That's the reason that I selected Houston. I knew overall for multifamily, we were overdue for a recession. So I looked into the Houston market and the Little Rock market to see what was the best fit based off of our operating skill set, our team structure, et cetera. And that's how we landed in Houston for our first few properties. So it's a matter of kind of understanding not only what's going on, what your skill set is, where the future is, because I think the difference between investing in residential real estate is you're investing for today and within, 6 months, year max. With multifamily, large multifamily, you're investing in the future, a 3 to 5 year horizon. So you really need to be well equipped on market cycles and where a specific market and asset class is going.
Yeah, it's like development. If you're developing a community, for us, some have taken 10 years. So you better have a long-term vision for that development. I mean, we try to get in and out in 3 to 5 years, but on the bigger ones, it simply takes longer. And if you're doing a full renovation on multifamily, that's going to take some time too to up the rents and increase the value of the property. So I feel like one of the big mistakes people made is being just too darn optimistic on either the renovation, the cost of those renovation, the belief that interest rates would stay at 0% forever. I mean, we know that it's kind of a bloodbath out there. Multifamily was the thing that everyone was investing in over from 2020, like you said, to 2022. I would speak at groups of doctors who were full-time ER doctors, and yet they were syndicating and they'd never done it before. They were bringing together other doctors, all putting in millions of dollars, and I believe they all lost their money. When I spoke at those events, I would warn them, like, you worked hard for your money. Like, you worked real hard for your money. You have debt. You've done this. You took you 10 years to get anywhere in your profession, yet you think you can be an expert overnight in something else. And, I warned them. And when I was at the cocktail party later, I had a few people mansplain me that I was wrong and blah, blah, blah. And anyway, had to get off my chest. But let's talk about what you're seeing now as a result of some of those decisions.
There are a lot of things that I'm seeing now. I think there were a lot of folks that outside of just doctors who were doing exactly what you said, where they're coming in, they didn't have the experience. Some people got lucky, some people did not get so lucky. And the folks that didn't get so lucky are in the middle of capital calls, they're in the middle of foreclosures, a lot of challenging aspects to multifamily. And then you have coupled with that, the only time in history where we've had the CDC step in and have regulations with respect to eviction laws nationwide on operating and impacting operating. And it's still to this day impacting operations across the entire country. It's changed a lot of eviction laws, both at a state and local level, and even in landlord-friendly states. So I think there are a lot of lessons to be learned during this process. I think that we are definitely seeing a cream rises to the top scenario. I remember speaking at a multifamily conference a few years ago when this whole thing started to unfold. And I was speaking to a few folks in the industry who questioned me on why I wasn't doing capital calls. And I said, well, I don't need to do a capital call. And they said, yes, but everyone's doing it. If you're going to do it, you should do it now because no one will question you because everyone's doing it. And I said, well, people should question me because I don't need to do a capital call. And if you're sharing financials and you're being transparent with your investors and you're safeguarding the investment as we are all tasked to do, that's the business plan. I don't see the need to do this. And they really, looked at me like I had two heads. They were like, you're going to regret not doing this. But I saw so many people do a distribution fully knowing that they were going to do a capital call the next month. And we weren't about that. We proactively halted our distributions. We were one of the first groups to halt distributions across all properties to build up reserves because we just saw the writing on the wall. We had the eviction challenges. You also had a run up on insurance with all of the natural disasters going on. Insurance providers were leaving markets. So in terms of just the supply of insurance providers within a given market was shrinking, let alone the exorbitant amount that you had to spend on replacement costs. So that's what insurance companies are insuring against. So it was perfect storm there. And then taxes. We had all these run up on sales. So then the tax authority was like, okay, we want to capitalize on this opportunity too. We're going to hit all of these properties with this new tax hike. So there was just a lot of things that I think made it challenging for the industry to operate the way they used to operate.
Not to mention interest rates, I mean, being the big one, right? And most of the commercial loans are short term and do need to be refied. And then many people went on, the bridge loans that had a limit. And so it just seemed like there was a general belief that rates wouldn't go up. And most of the stuff I saw, the underwriting I saw, was assuming that. So just that alone is making it tough for people, right?
100%, that was the number one reason. I mean, without a doubt, that was the biggest impact in the industry. I think all of these other things definitely impacted it. Mm-hmm. I know that we often get asked to partner on different deals for a lot of different reasons. And I have reviewed all the deals that we get sent to us. And the number one reason we don't even move forward to a thorough analysis is because there's also an assumption that if one unit can command a certain price, that means that all units of similar nature can. And people miss this whole concept of absorption. So when they're doing rental analysis, they'll look at a neighboring property and say, well, that 2-bedroom, 1-bath at 900 square feet is getting $2,000 a month. So our 100 of 2 bedrooms, 1 bath at 875 square feet can also get the same rent. And there's this whole concept of absorption that you have to consider as well. And I think what ends up happening is you inflate these rents to a point where you can never catch up on the value because people aren't considering that, just like on single family homes, there's a threshold of how much you can push a rent based off of supply.
Such good stuff, Ashley, and clearly shows how much experience you have and how you've been able to make really good decisions in probably one of the toughest times. So what are you doing now? Are you still in acquisition mode? Are you trying to just stabilize what you've got or get rid of what you got? Like what are you looking forward to and what are you working on?
So for our existing portfolio, things are going actually quite well. I like to say that, when a lot of people were turning and burning, I didn't know what I was doing at the very beginning. So I am a type of person, I have to know every single detail. So for better or for worse, and in this situation, it ended up being okay because during the hardest time, I actually thought it was easier than when I first got started. So that has kind of been really good. With respect to selling the portfolio, we're not in a position where we have to sell any of the properties. They're all doing pretty well. And this is a buyer's market. So from an investment standpoint, I don't think it would be opportunistic to sell right now. On acquisition mode, we have a development deal that breaks ground in November that we're really excited about. The numbers on it every single time we get a new market survey report, we got one last week, is just showing incredible growth in this market. So we're really excited about the future within that market. We have a couple partnership deals that we're exploring right now. And then we also have deals in our pipeline that we're underwriting. We don't acquire a lot, but when we acquire, it's normally a deal that we get at a good basis just because we are ultra conservative, but I think that's landed us well because we've never had to do a capital call. And I think that's a good reflection on how conservative we are. So it might take us a long time to acquire something, but the trade-off is that, these hopefully are pretty solid deals once we get them under contract.
I 100% agree. And I've been ultra conservative because I wasn't when I first started syndicating over 15 years ago. Not that I wasn't conservative, I was just willing to take more risks and just doing, again, riskier projects, which I wouldn't do today, like a development in Costa Rica. That's not easy to pull off. Oh my goodness, if I could just talk to my younger self. Anyway, that's why I like to talk to other people so that they could learn from my lessons. Do you see opportunity today? You said it's kind of more of a buyer's market. Does that mean it's a good time to buy multifamily?
I think it's always a good time to buy in every asset class. It just depends on what you're paying and what your business plan is. So right now, I think it's the best time to buy. If you believe that real estate values tend to go up over a long period of time, multifamily is a marathon. It's not a sprint. So the concept is that you will hold it long enough to realize another, hopefully, dip in interest rates or a comeback on cap rates. So I think that there's huge opportunity, especially there are metrics to suggest that we are anywhere between a 15 to 35%, which I know is a huge spread on valuations from the peak. So if we look at it over a long period of time, the historic look back on valuations, we tend to see those fluctuations happen anywhere from a 5 to 12 year period of time. So most multifamily is 3 to 5 year hold, but there are some longer term projects, especially if you want to participate, for example, in opportunity zones. So this is, I think, one of the best opportunities in recent history to buy multifamily. And I also believe that unlike residential real estate, you realize the bottom in part because the average transaction in residential real estate across the nation is 45 days. The average real estate transaction in commercial real estate is 60 to 90 days pre-COVID. I would argue it's probably between 90 to 120 days today. And when someone puts a property under contract versus when they sell or when someone buys, it's a reflection of the valuation 3 months prior plus. So to me, once we start to realize the bottom of the market, it'll have happened 3 months prior, if not greater than that. So I think there's a lot of people that would argue and suggest that we are at the bottom of the market. I personally think we are. I think we've stayed at the bottom for a little bit of time. I think, we'll continue to see some steadiness for the short-term horizon, but I think long-term horizon, I think we're going to look back and say, why didn't we buy more? And the reason I believe that in part is because of the recent tariff and immigration policies. Because if you look at construction, which construction impacts all types of real estate, there are only two factors that impact construction prices, and it's labor and materials. And we have two significant policies right now that are impacting both aspects of construction, which are deterring people to build and deterring people to buy heavy value add, which in turn impacts supply. So that's why I think now more than ever before is the best time to buy commercial real estate.
Well, Ashley, it is always so much fun to talk to you. You're just a wealth of knowledge. So thank you for sharing with us today on the RealWealth Show.
Thank you so much for having me.
And this is one of the reasons why the women's syndication group that we did at my house was so powerful, to have that kind of input with a room of powerful women. I want to do that again. Let's do that again.
Absolutely. I'm in.
Okay. All right. Well, have a wonderful day, and I hope to see you soon.
Thank you. You too.
And thank you for joining me here on the RealWealth Show. I absolutely agree that now is the time to jump into multifamily. Values have come way down in some markets. There's starting to be more supply. And in certain areas, they are not as interesting to the hedge funds. And that's what we're focused on with my new syndication, a multifamily fund, where we can be ready to pounce on those opportunities when they come. If you want to find out more about that, you do need to be an accredited investor. This would be a 506C. You can just go to realwealth.com, join, and get on the list so that you'll know all the new exciting opportunities that come along. Again, that's realwealthshow.com. It's free to join, and then there'll be several questions of what you're trying to achieve in real estate, and we'll make sure to only direct our emails to those things. We will not blow up your inbox with things you don't want. Okay, I'm Kathy Fedke. Thanks so much for joining me here on The Real Wealth Show, and we'll see you next time. And if you're interested in my next women's retreat for women who syndicate or want to syndicate or doing bigger deals in real estate, just reach out. You can reach me directly at kathyfedke.com. All right, thanks so much for joining me here, and we'll see you next time.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.